Thank you so much, Sunil. Thank you, Ann. Thank you, James, for the warm welcome. It's a tremendous pleasure to be here. And I'd like to start off by thanking all of you who are online with us here for joining the conversation. Obviously, also particular thanking you, Jay, for joining us. Because I believe, as Sunil alluded to, that having a broader conversation about the governance of finance is both important as well as urgent. I'm very grateful to be able to share a few thoughts with you and then more importantly, discuss and jointly take that debate forward. So the governance of finance, which I would loosely define as the rules and policies and the mechanisms that provide the guardrails for financial markets, is a central pillar of our economies and societies. And as Sunil said, whether we succeed in improving lives, in creating opportunity, in strengthening communities, and in also protecting nature depends greatly on financial markets and thus ultimately on how we choose to govern them. And yet, interestingly, surprisingly, alarmingly, for a very long time, we did not have these type of conversations on the governance of finance and on the links between the institutions governing finance and the broader topic of sustainability and sustainable prosperity. And instead, we progressively narrowed down the conversation to the view that everything that central banks can and should do is about price stability, financial stability, and in some countries, actually narrowing it down to a purely price stability focused conversation. And I think that got us onto a wrong track, at least the wrong track for the challenges that we're facing today. I also happen to believe that this narrative about a narrow mandate of the institutions governing finance does not match up with reality. Because if you look closely, the institutions governing finance do so much more than this narrow narrative around price stability would lead us to believe. If you take the Federal Reserve, they would list at least five key functions: conducting monetary policy, taking care of microprudential supervision of individual financial institutions, taking care of macroprudential policy to ensure the financial stability of the entire system, having a role in payment and settlement systems, and finally, also playing a crucial role in both consumer protection as well as community development. And then, Sunil was referring to that as well, came COVID-19. And I think with that, yet another glaring spotlight on this absolutely critical role that the institutions governing finance play. Because whether governments had access to funding to increase healthcare capacity, whether corporations were able to secure liquidity to secure jobs and come back after lockdowns, or whether we had the payment systems in place so that emergency cash could actually reach the households in need, at the core of all that stood not only, but also central bank and financial supervisors playing their role. And recognizing this broader role these institutions have in both normal times and during crises, I believe is essential. And I hope that the conversation we're having today can contribute to a broader debate that will help increase momentum. And Anne has already alluded to the fact that we're seeing emerging practice in that direction, to increase momentum to ensure that the governance of finance, its purpose, its instruments, and its institutions get better aligned, more aligned with what I think the ultimate goal must be, and that is sustainable prosperity. So let me start with what I would see as the first building block here, the purpose of the governance of finance. The purpose of the governance of finance has never been set in stone. The mandates of central banks and financial supervisors have kept evolving over time. After World War II, the central banks played a key role in the development of countries. You had several central banks worldwide that were intricately involved in channeling capital flows to priority sector and to targeted infrastructure. And then in the leading up to the 1990s, as inflation went up, we had this consensus that is still around today, emerging that no, this is not the role of central banks. Central banks should be focused very narrowly on price stability. And in order for them to do that, they need a certain degree of autonomy from politicians and policymaking. And then came 2008, and we realized that a narrow focus on price stability doesn't safeguard us against a crisis. We suddenly realized that financial stability is equally important. And we saw central banks come in with greatly expanding their toolbox, the instruments they were deploying, and moving financial stability up their agendas. And since then, I would argue policymakers have increasingly recognized that even that is not enough, that even if we keep an eye on price stability and financial stability, these are not sufficient prerequisites to safeguard sustainable prosperity. In spite of, we can have price stability and financial stability, but we would still have high unemployment, stagnating wages, increasing inequality that endangers social cohesion, environmental threats, which are not captured by a narrow view on price stability and financial stability. And while I'm far from arguing that those governing finance can solve all that, I argue that they must play a role. And I would quote the G20, which has repeatedly said that in addressing all these questions that Ann also alluded to earlier, all hands need to be on deck. And we simply cannot carve out financial governance from that imperative. Such a broader purpose for central banks and financial authorities and other agencies involved in the governance of finance does not preclude us from setting priorities. Price stability and financial stability will always rank high, I think, on the agendas of central banks. It also doesn't preclude us from setting primary goals and secondary goals. But the broader purpose of sustainable prosperity, I would argue, must be firmly embedded in the mandates and the practice of the institutions governing finance. And now, interestingly, and I would think crucially, central bank mandates are, in most cases, already much broader than this prevailing narrative around a narrow set of objectives would lead us to believe. Take again the Federal Reserve. Its monetary policy mandate covers 3 objectives: employment, price stability, and moderate interest rates. The Bank of Canada has the objective of, and I quote, to promote the economic and financial welfare of Canada. And interestingly, the European Central Bank, which is often seen as this poster child of a central bank, which is completely independent and has a narrow mandate, the ECB, yes, has price stability anchored in its mandate as its primary objective, but then the mandate of the ECB goes on and says, without prejudice to the objective of price stability, the ECB shall support the economic policies in the European Union with a view to achieving the goals of the Union. And in the original text, it says, as defined in Article 3. And if you then look into Article 3 of the European Treaty, you would find a whole range of sustainability objectives referenced in there, including full employment and a high quality of the environment. It's in there. Which brings me to the very important topic of the interpretation of mandates. Because while legislation already very often defines the objectives, the purpose of the institutions governing finance in a much broader way, in our interpretations over the last 2-3 decades, we have narrowed it down. And here, I would like to again use the ECB as a case in point for 2 things. On the one hand, how parts of its mandate got ignored for a long time, but also, again, linking back to what Ann said, how this is shifting now. And let me just, by sharing my screen, share two quotes with you here. Just need to go up here. Here we go. The first one from Mario Draghi, then the president of the European Central Bank, who in 2015 said, the mandate entrusted to the ECB is to safeguard price stability in the euro area. That's where his sentence stopped. The second mandate was not mentioned, and this is not the only example that is out there. And the more recent illustration coming from Frank Elderson, who joined the executive board of the European Central Bank recently, and an article wrote that actually two crucial things. On the one hand, that the second part of the ECB mandate, he says sometimes, I would say frequently, got overlooked. And that this second part of its mandate is a duty, not an option. Jens Weidmann, the president of the German central bank, the Bundesbank, said in a recent speech, and again, I'd like to quote him, it is not up to independent central banks to correct or replace political decisions. And he was saying that, arguing against a larger role of central banks in addressing climate change. And I think he's right when he says that central banks should not correct political decisions. But I think it is equally true that central banks should not be choosing to follow parts of their mandate and to disregard other parts. And that very much applies to the ECB. Which leads me to the second core building block to align financial governance with sustainable prosperity, the instruments that central banks and financial supervisors deploy to fulfill their tasks. Financial governance rests on a vast and actually growing toolbox. The instruments at the disposal of those governing finance range from moving policy rates, interest rates up or down, asset purchases, targeting refinancing lines, setting capital requirements, doing stress tests across the sector. They also include security regulations, as well as the development and maintenance of key parts of financial market infrastructure. I mentioned the role that the Fed plays earlier with regard to payment and settlement systems. And ensuring the coherence of these instruments with that broader notion, this broader goal of sustainable prosperity, I think is at the core of what those responsible need to do, and assessing the trade-offs in between the different goals that I think should be on their agenda as they deploy these instruments must be a core part of that. And I'd like to just give you a few examples of these type of trade-offs that I'm thinking about, and thereby also illustrate that dealing with trade-offs is already very much part of institutions governing finance. And I'm mentioning it because very often when we talk about the need for a central bank, for example, to look at climate change or to look at inequality, one of the responses we get is, well, no, that you're getting them into a trade-off and you can't let them deal with trade-offs. They're not meant to do that. And I think that just doesn't match up with reality, because they're already dealing with trade-offs. They're already pursuing goals with regard to price stability and financial stability. They're already in their role as financial supervisors, safeguarding financial markets by being stricter on banks, but at the same time seeking to drive innovation and competitiveness, which might lead them to be less strict on certain areas. And just to give you a few more examples on where these trade-offs are, just a few here. So central bank lending and asset purchases may be effective in reducing deflationary tendencies in meeting price stability goals, but as I was alluding to, but may come at the expense of financial stability. And moreover, central banks engaging in asset purchases to pursue their price stability goal may actually be exacerbating wealth inequality. Depending on the assets that they purchase, central banks may actually also furthermore create environmental risks on their own balance sheet and to the economy as the whole. And finally, stricter compliance measures for banks may mitigate against bank failures or financial crimes, but as I said earlier, may make it more difficult for smaller banks to compete and thereby counter the objective to raise competitiveness in the financial sector and to move against concentration tendencies in finance. And accounting for these different effects and aligning the toolbox with this broader set of objectives, I think is crucial as we explore a potential evolution of the governance of finance. Let me zoom in on one particular area where these broader sustainability objectives have already made an inroad into the governance of finance, and that is the increased engagement among central banks on the topic of climate change. 10 years ago, the notion that central banks and financial supervisors can and should play a role in addressing climate change would have, and I know because it happened to me, would have created blank stares and a lot of questions of what one thing has to do with the other. And today we have just to give you one example, central banks and supervisors network for greening the financial system with 100 members worldwide, central banks, supervisors, including, by the way, since last December, the Federal Reserve, that has the aim, and I quote again, to share best practices and contribute to the development of environment and climate risk management in the financial sector, and to mobilize mainstream finance to support the transition toward a sustainable economy. And I wanted to share this objective with you in full because I think it illustrates in a perfect way the two different narratives under which the engagement of central banks and supervisors is being driven forward on climate change. Most of the engagement so far among central banks and financial supervisors is being driven ahead under what many, including me, refer to as a risk narrative, where the argument is that climate change poses financial risks. And because of these financial risks, it is in the remit within the mandate of central banks and supervisors to address that issue. And for example, to make sure that their own balance sheets as central banks are protected against such financial risks, and that the financial institutions which they supervise, as well as the system as a whole, is protected against climate risks. Some of the engagement is already going a step further, pointing to the need for policy coherence and arguing that it doesn't actually make sense to limit ourselves to deal with a challenge that is as big and as, I think, Sunil, you mentioned the word existential as climate change, to deal with such a threat solely through the lens of what it does to price stability and financial stability, but to rather say this is a goal that we need to address in and of itself. And being clear about these two different narratives, the risk narrative and the policy coherence narrative, is, I think, immensely important also to understand the different positions that people take on it. And some of you may have listened to or read about yesterday's hearing in the US Senate with Federal Reserve Chairman Jay Powell, in which Senator Brown opened, amongst other things, with the following statement saying, the Fed can require that financial institutions take into account the serious risk posed by the climate crisis. And where subsequently Senator Toomey said, and I quote again, as noble as the aim might seem, addressing issues such as climate change or racial inequality are simply not in the purview of the Federal Reserve. And for me, I think, again, this is a perfect illustration of the different narratives because as I understand it, Senator Brown is referring to the risk narrative and Senator Toomey argues against the broadening of central bank objectives that would result from further pushing towards policy coherence. I'm bringing this up here because I think it is important for us to keep that in mind, because very often what we see worldwide in this conversation is that people talk past each other. Some talk about a risk approach and some talk about a policy coherence approach. And we need to acknowledge that the momentum on the risk approach is much more advanced than what we see on the policy coherence side. And I'll talk a little bit about that in a second. So within the risk frame, central banks are exploring how to better account for climate-related financial risks within their own monetary policy operations, as well as in their role as supervisors. And the starting point for that work is the view that the risk metrics that are currently out there guiding financial market participants do not sufficiently account for climate-related financial risks, including the risk metrics, for example, that underpin monetary policy decisions, that underpin the decision, for example, whether a central bank buys a certain asset or accepts a certain asset as collateral or not. Central banks today, basically worldwide, use rating agencies or the ratings they get from external rating agencies to determine whether assets meet the risk thresholds that they've set themselves. And at the same time, central banks are out there saying the ratings that we get from rating agencies do not sufficiently account for climate risks. And the logical conclusion is obviously, well, if that is the case, and if we want to ensure that our own risk standards are adhered to, we need to build in additional risk analytics to make sure that if we only want to buy, let's say, BBB corporate bonds, that what we buy is actually BBB and doesn't come with a big additional climate risk that is currently unaccounted for. Other central banks have started taking this a step forward towards more of a policy coherence approach. And here again, I would like to share a slide with you with two quotes. The first one from the governor of the French Central Bank, Mr. Villeroy de Gaillot, and the second one from the chairman of the governing board of the Swiss National Bank. Mr. Villeroy de Gaillot said recently, actually, let's face it, the ECB's balance sheet is exposed to climate risk through the securities it purchases and the assets pledged as collateral by banks to an extent that is insufficiently taken into account, and he proposes to start decarbonizing the ECB's balance sheet. This is the concrete step that is now on the agenda of several central banks under a risk narrative to align their instruments with a broader sustainability agenda. And in contrast to that, you had the Swiss National Bank last December effectively taking a decision that is not completely similar, but using a different argument, saying in Switzerland, there is a broad consensus to phase out coal. And this is why we as the central bank, in aligning ourselves with the broader objectives the country has, will exclude all companies that are primarily active in the mining of coal. And again, I'm sharing this as an illustration of how different narratives drive decision-making and how the alignment of instruments then looks like. Accounting for climate change considerations in the context of monetary policy is just one of many examples where such alignment is, I think, urgent. And if we have time later on, Sunil and Jay and Ann, I'd be delighted to explore this further with you. For example, to what extent other instruments in the monetary policy toolkit, such as targeted refinancing lines, could be better aligned with sustainability objectives. Some of you may have seen, for example, that there are suggestions out there for targeted refinancing lines that would fund energy efficiency renovations across Europe. There's certainly a big discussion to be had around the integration of climate risk considerations into financial supervision, both on the micro as well as the macroprudential policy side, and what that, for instance, would mean for capital requirements. And finally, moving to a completely different topic, there is, I think, a great need for central banks and financial supervisors to better understand the distributional consequences of what they do, the impact on inequality, and to think through how could the instruments they deploy be recalibrated to reduce the distributive impact that they currently have. But let me end here on instruments and move over to what I think is the third building block to align financial governance with sustainable prosperity. And these are the institutions. The organizational setup that we have that drives financial governance. And let me start off with an alignment or with an example of the types of alignments that are already happening now, linked to the previous discussion on climate change, which is the buildup of capacity within central banks in addressing climate crisis or climate risks. The Fed is a case in point, as you see on this slide. It has recently announced the establishment of a supervision climate committee with a senior member of the New York Fed moving over to the Federal Reserve Board, bringing together senior staff members from the board as well as the Federal Reserve banks. Similarly, the ECB recently announced the establishment of a climate change center. Notably, however, was the difference that the ECB center in its design is also meant to cover the impact of climate change on monetary policy, whereas my understanding is that at least so far, this new committee at the Fed is focused exclusively on the supervisory role of the Fed. And my hope would obviously be that this gets expanded to also put into scope the role of climate change within monetary policy. More generally, and in addition to building up capacity on new issues such as climate change and inequality, the alignment of the institutions governing finance with a broader sustainability agenda must also be anchored in the processes through which decisions are taken. And I know that Ann and Sunil have written extensively, for example, on the importance of busting silos and of bringing in a diversity of views to take decisions on matters that are as complex as the matters that that central banks face. So alongside with that, there's also a great need, I think, to expand capacities, beliefs, and assumptions that these institutions hold, as well as the mechanisms to ensure transparency and accountability. And while first steps in that direction to broadening expertise and perspectives have been taken, I would argue progress has been very slow. So if you look at educational, social, and professional backgrounds at central banks, they continue to converge on a very narrow range. Gender and racial diversity remains low. Alarmingly, the 19 national central banks in the Eurozone are exclusively presided by men. Only 2 out of 12 regional Federal Reserve banks in the US are run by non-white presidents. The other 10 never had a non-white president throughout the Fed's history. The advisory groups that central banks engage with to get information, to get different views, are largely confined to market participants. And the models that are being used in central banks still, I would argue, only reflect a very narrow range of schools of thought. And I think this must change. To meet the complexities that these institutions face, there must be a broader range of views. There must be a broader range of experiences being brought to the table. And now finally, let me end on the topic that usually comes up first when one enters a conversation around central banks, and that is their independence. And I've deliberately put this topic to the end because I think starting with it, doing what we very often hear, which is arguing that you cannot ask central banks to do X, Y, Z because that would endanger their independence, I think that just puts the logic upside down. Because in my view, we need to first understand and decide what the purpose is of an institution, what the powers and instruments are that we give to it in order to pursue that purpose, before we talk about the institutional setup and the degrees of independence that this requires. And at the same time, obviously, the discussion about independence is a crucial one and actually already on its way. Because Sunil, I think you did mention already that the powers of central banks have extended significantly. Therefore, the repercussions they have on a broad array of societal issues has expanded. And that obviously brings the question whether the decision-making processes that have been put in place 30 years ago are still aligned with that broader toolbox. And I think we're in for a reassessment. And I would like to propose 5 aspects to guide this reassessment. First, central bank independence is not a binary concept, but a matter of degree. Financial authorities, like any public agency to which powers are delegated, require an adequate level of autonomy to deliver on their mandates, but at the same time, they never act in a vacuum, but are subject to narrower or wider guardrails that are to be defined. Second, reviewing the independence of central banks requires a clear distinction between their role with regard to monetary policy and their supervisory functions. And I think it's interesting that very often these two aspects get thrown together and we just talk about the independence of central bank, forgetting where that notion that central banks should be independent actually comes from. It comes from the view that in order to guarantee price stability, we need a credible commitment by the responsible agency that it will stay on a certain path to safeguard price stability, to keep inflation below a certain target, which is a very different area than what they do on their supervisory side. So we need to really keep separate the independence that is required in these two areas. Third, appropriate levels of discretion must be aligned with the instruments that are being deployed and the effects they have. So a central bank that does nothing else but moving a policy rate up or down has much less societal repercussions than a central bank that engages in setting policy rates, in asset purchases, in yield curve management, in targeted refinancing lines, in emergency credit lines, and the list goes on. And we need to keep in mind what the toolbox really looks like and what type of effects it has to have, I think, a comprehensive discussion around independence. Fourth, a review of independence must be granular. Degrees of discretion can vary across and within instruments. We might want to give full discretion to a central bank to decide about the size of its balance sheet, but that doesn't preclude Parliament from giving guardrails on what these assets on the balance sheet can be invested into. We might decide that central banks can act as lenders of last resort, but under certain circumstances require congressional approval or at least involvement. Or as happened as a result of the last financial crisis, we might say, when in the case of the Fed, you can install emergency lines, but there needs to be an involvement of the Treasury in it. So there are very different degrees within instruments of independence. And I think we should make use of these different features and think through where we require which institution with what capabilities to take decisions. And finally, I would argue that independence must be understood broadly, and thus not only cover the level of autonomy a central bank has from a government, but also the ability to take decisions without undue influence from other actors. The extent to which central banks are dependent on market participants in transmitting monetary policy, the degree to which regulatory capture affects supervisory decisions, and the constraints on financial policy posed by one central bank on another. Take, for example, the impact that swap lines that the Fed offers or that the ECB offers have on the ability of other central banks who get such a swap line or who don't get such a swap line, that is significant. And I think we need to understand independence in that broad concept. So with that, the purpose, the instruments, and the institutions, let me just end on reiterating that I believe financial governance must be aligned with the broader objective of sustainability, prosperity. The concrete interpretation of that objective will vary from country to country. It will also vary across time, but I think it provides the compass that must guide financial authorities in their decisions. And I believe our current view on what financial governance is and what it should be falls far short of that. And my hope is that conversations such as the one we're having today can contribute to deepening our understanding of where we stand and give us an impetus to think through of where we want to go to, and most importantly, how we get there. And with that, I stop, and I really look forward to the conversation. Thank you.